Welcome back to the deep dive. Today, we're digging into something pretty specialized in the crypto world, machines cash, or machines. This one's making noise because it claims to tackle a really big issue in DeFi, how to spend your crypto privately. And you, our listener, gave us a whole stack of material, basically setting us a clear mission. We need to figure out, what is this product, really? How does it work with something like Visa? And crucially, who's actually behind it? What's their plan based on their roadmap? And that price chart. Wow. What is that wild ride telling us?
Yeah, looking through the sources, it immediately jumps out at you. This project, Machines Cash, it's tackling a real need. I mean, privacy for DeFi spending, that's definitely a gap in the market.
Right.
There's real utility potential there. But, and this is a big but, the research also flags some major early-stage risks. It's pre-launched, the token's been incredibly volatile, and maybe the biggest thing, who's running the show? It's not clear. Very anonymous.
So it's that classic crypto tension, isn't it? Genuine potential versus, well, a lot of unknowns and risk. Accountability seems like a key theme here.
Exactly. Utility versus accountability. That's the tightrope this project is walking. We really need to break that down piece by piece.
Okay, let's unpack this then. We absolutely have to start with the core idea, the product itself. Does it hold water enough to justify taking on those risks we just mentioned? All right, so Machines Cash. Fundamentally, it's trying to connect your crypto wallet to, well, everyday spending, but without leaving a big public trail. It's pitched as a privacy-first crypto spending platform, and they've chosen to build it on Base. That's Coinbase's layer 2 for Ethereum. Why Base? That seems significant.
Oh, definitely. Building on Base is a smart move, strategically. Right. Layer 2s like Base, they give you the security of Ethereum, basically, but transactions are much faster and way cheaper.
Which you absolutely need if you're talking about small, everyday payments, right? High gas fees would kill it.
Precisely. It signals they're thinking about scalability and user experience from the get-go. It plugs them into Coinbase's ecosystem, too. But the real trick, the core innovation, is how it provides privacy. See, normally, if you pay directly from your crypto wallet, whoever you're paying or anyone looking at the blockchain can potentially see your whole transaction history, your holdings, everything. Machines Cash aims to cut that link.
Wow.
It lets users generate what they call unlimited virtual Visa cards. You load these cards up with crypto, and then you can spend anywhere Visa is accepted.
Okay, hold on. Virtual Visa cards, that immediately flags a question. How does a project promising anonymity interface with a heavily regulated system like Visa? That sounds like a huge hurdle, especially for an anonymous team.
That's the million-dollar question, isn't it? And the sources suggest the mechanism is focused on masking the transaction at a technical level, not necessarily dodging regulation itself. Think of it like Apple's Hide My Email feature.
Okay, explain that analogy.
With Hide My Email, the person you email gets a random disposable address, not your real one. Machines Cash seems to work similarly for payments. The merchant you pay sees a standard Visa card number.
Ah, so the merchant just sees a normal transaction. They get paid in regular currency.
Exactly. They receive fiat. The card number they see is tied to a unique, kind of isolated account within the Machines Cash system. The crypto funding part is shielded from the merchant.
And critically for the user, their main crypto wallet, the one with all their history, isn't directly linked to that specific purchase.
That's the core privacy promise. Each virtual card you create essentially gets its own separate mini account and its own blockchain address on the back end within their system.
So if I use one card for, say, a subscription and another card for online shopping,
the transaction histories for those two cards stay separate, and neither trail leads directly back to your main public wallet address. It compartmentalizes your spending. Total transaction masking, that's the goal.
okay, that's a powerful privacy feature if it works as described. What about just using it? Is it convenient? The sources mentioned ease of use.
Yeah, they seem focused on low friction. Apparently, there's no separate app you need to download. The virtual cards are designed to work directly online, anywhere Visa is accepted. It's a huge potential user base.
And connecting your wallet.
They're aiming for broad compatibility, too. The sources mentioned support for MetaMask, Coinbase Wallet, Wallet Connect. Basically, the big ones most DeFi users already have. Makes onboarding easier.
Good. And funding these virtual cards, can you only use certain cryptos?
No, it seems pretty flexible there, too. They list support for Bitcoin, ETH, stablecoins like USDC and USDT, and other popular cryptos.
Yeah.
That's smart. You don't want to force users into awkward swaps just to top up a card.
All right, let's switch gears slightly. One thing that often worries me with new crypto projects is how they plan to actually make money, beyond just hoping the token price goes up. Does Machines Cash have a sustainable business model outlined?
Yes, and this is actually a significant positive point highlighted in the research. They aren't just relying on the token, they have a clear, tiered subscription model laid out. This suggests they're thinking about long-term revenue, like a traditional software as a service company.
Wow. What are the tiers?
There's a free hobby tier. Gives you 3 virtual cards to start, and then it's like $1 for each extra card you want. Classic freemium approach, right? Get people in the door.
Makes sense. And then paid options.
Yep. There's a pluses tier for $9 a month that bumps you up to 18 virtual cards, still $1 for extras.
Okay.
And then the top tier is Pro. That's $29 a month, gives you 78 cards. And extra cards are slightly cheaper, $0.80 each. But the really interesting part of the Pro tier,
What is it?
it includes advanced analytics and, crucially, API access.
API access. Okay, that tells you something. That's
Yeah.
not typically for your average casual user, is it? Who would need API access for privacy-focused virtual cards?
Exactly. That signals they might be targeting power users, maybe financial analysts, or even businesses. Think about companies that need to manage lots of separate, maybe anonymous-looking online payments, digital marketers testing ads, researchers, companies needing geographically diverse payment sources.
Right. Things where you wouldn't want all transactions linked back to one central corporate account easily.
Precisely. If they can tap into that B2B market with the Pro-tier API, that could generate substantial, steady revenue that has nothing to do with the day-to-day swings of the machine's token price. It adds a layer of potential stability to the whole operation.
So the product idea sounds pretty compelling, and the business model seems thought out, which makes the next part even more jarring. We have this potentially powerful tool interfacing with traditional finance built on a credible chain. But who is actually building it? You asked us to find out who the team is, and the answer we got back from the research is, well, unsettling.
Yeah, this is probably the biggest red flag the deep dive uncovered. It's stark. There is essentially no publicly available information identifying the founders or the core leadership team behind Machines Cash.
None. Like, zero names.
0 names linked directly to the project in any official capacity that we could verify through standard crypto data sources or public records. The project maintains a high degree of anonymity regarding its creators. It seems very deliberate.
Why? If you're building a financial product, especially one that promises privacy and security, wouldn't you want to build trust by showing who you are? Anonymity feels counterintuitive here.
It absolutely does feel counterintuitive from a user trust perspective. The only clues about the team come indirectly. The sources mentioned they talk about their product development timeline and announcements.
Right, focusing on the what and when, not the who.
Exactly. It's all passive voice. Alpha testing will begin, not our team will begin alpha testing. It carefully avoids attribution. And let's think about the implications again, especially with that Visa integration. Interacting with payment networks like Visa involves strict regulations. KYC, know your customer. AML, anti-money laundering. Even if the end user's crypto wallet is masked from the merchant.
Someone has to be handling that compliance on the back end, right? The entity actually issuing or managing those Visa numbers must be identifiable to Visa and the regulators.
You'd absolutely think so, which leads to a couple of big questions. If they are compliant behind the scenes, that implies there must be some registered legal entity somewhere. So why hide that entity from the public? Who is accountable if something goes wrong?
Yeah, like a security breach or funds disappearing or even just the service shutting down if the team is anonymous.
There's basically no public recourse, no one to hold accountable. The research flags this lack of team transparency as a major risk. It forces users and potential investors to take a huge leap of faith. You're trusting anonymous developers with a tool designed for financial privacy and interfacing with regulated systems.
It really puts the user in a tough spot. You want the privacy the tool offers, but getting it means trusting unseen, unknown people handling the infrastructure. It's a paradox.
It is. Maybe their rationale is extreme privacy, protecting their own identity to better protect the platform's goal. But from a practical risk standpoint, it leaves users potentially exposed. The compelling use case clashes directly with the lack of public accountability.
Okay. So without knowing the who, the market has to rely almost entirely on the what and when. Let's pivot to what the team is actually communicating, their plans for the future. Despite the anonymity issue, the sources do show the team is actively communicating, right? They have a clear public roadmap. This seems to be the main thing giving the project forward momentum, the primary basis for any future prediction.
That's correct. This is the positive flip side to the transparency concern. The research highlights a very active and clearly defined development timeline. They're not hiding their plans. As of late November 2025, they're openly stating they are in the pre-launch phase. The product isn't ready for prime time yet, and they're upfront about that.
And their communication, like on social media, focuses on this roadmap.
Very much so.
Yep.
The analysis of their official communications, particularly on Twitter, shows it's almost entirely centered on hitting specific milestones. They're constantly referencing the next steps, the upcoming phases. It's all about delivery dates, not hype about the token price, which is frankly a good sign in terms of focus. It suggests ongoing work behind the scenes.
Okay, let's get specific. What does this roadmap predict for the very near future? There's a pretty rapid sequence of events planned, isn't there?
Extremely rapid. It's basically a 3-month sprint they've laid out. The prediction starts almost immediately in December 2025. That's when they say the alpha testing phase begins.
Alpha testing. So mostly internal, right? Finding bugs, security checks.
Typically, yes. Very limited access, maybe just the core team, and possibly some very early trusted testers. It's the first real test. Can they actually produce working code that does what they claim? Successfully hitting this alpha deadline would be the first concrete proof of capability from this anonymous team.
And right after alpha.
The roadmap predicts beta testing starts in January 2026. Beta is a much bigger deal. That's usually when they open it up to a wider but still controlled group of actual users.
Real-world testing. Stress testing the system, seeing how the virtual cards perform in the wild, getting user feedback.
Exactly. Scalability, how smoothly transactions go through, edge cases. Successful beta phase would be a huge confidence booster and start to validate that product market fit.
And then the final step.
If alpha and beta go well, the prediction is for the general release, the full public launch in February 2026. So yeah, the entire prediction hinges on hitting these 3 major milestones within the next 3 months.
That's an aggressive timeline. But the fact that it's so clearly laid out and that their communication focuses on it is the key finding from the research regarding team activity, isn't it?
Precisely. It suggests a structured, professional approach to development, even if we don't know who's doing the developing. They're behaving like a team with a plan, focused on engineering deliverables. That's the main positive signal countering the anonymity risk right now. The immediate future prediction is all about hitting those technical milestones.
Okay, so we have a project with a clear plan, but an anonymous team. What about the community? In crypto, buzz and community support can be really important, especially before a launch. How active are people around Machines Cash? What's the general feeling, the sentiment, given the team is posting updates?
Well, the sources paint a picture of a community that's still very much in its infancy. The term used was nascent. Basically, it's small, it's early days, and this lack of broad visibility is a key finding itself. There's very little chatter about it on the big crypto news sites or general forums.
Is there data to back that up, like social media presence? That usually tells a story about reach and activity.
Absolutely. The data point that really stands out is their official Twitter account, @MachinesCash. It was only created in October 2025. And as of late November, when the research was compiled, it had just over 1,000 followers, 1,014 to be exact.
1,000 followers?
Yeah.
For a project aiming for global payments with Visa integration, that seems tiny.
It is objectively tiny in the crypto space for a project with such ambitions. And crucially, the engagement on their posts, likes, retweets, comments, was also minimal, according to the sources. It strongly suggests very limited marketing effort so far, or perhaps a deliberate choice to stay under the radar until launch. Either way, it's a red flag for potential organic growth. It shows a definite lack of broad market awareness right now.
That follower count, 1,014, that's almost forensic evidence, isn't it? It tells you that whatever is happening with the token's price, it's not being driven by some huge viral wave of public excitement. The action must be concentrated.
Exactly right. And that makes the sentiment data we found even more intriguing. Because even though the community is tiny, the feeling within that small group seems quite positive, or at least hopeful.
How so?
Well, for instance, one source cited data from the Phoenix exchange on November 6th. Over 24 hours, it showed 54.78% bullish sentiment for machines. That's more positive than negative. And another analysis looked at Twitter sentiment more broadly around that time. It found about 46% of tweets were bullish, compared to only about 17% bearish. The rest were neutral.
Okay, so a small group, but fairly optimistic. What does that combination usually suggest in crypto? Is it genuine belief in the tech or something else?
The synthesis from the deep research leans toward speculative concentration. It's fascinating because while the percentages are bullish, the volume of discussion is low, and it's not happening on mainstream platforms like Reddit or major Discord groups.
Meaning the buzz isn't spreading organically?
Exactly. It suggests the bullishness is concentrated among a small pool of early investors, people who are probably watching that roadmap very closely, maybe coordinating, and definitely focused on the token price, rather than a broad base of users excited about the product itself.
And that concentration in a small market, that increases risks, right?
Absolutely. When you have a low market cap, low liquidity, and a small but very bullish group of holders, it becomes much easier for coordinated buying or selling to dramatically impact the price. The risk of a pump and dump scenario is significantly higher in these conditions.
So the community activity is low overall, but the speculative activity within that small community seems disproportionately high, which leads us perfectly into looking at the evidence, the price chart itself. All right, let's dive into probably the most visually dramatic part of this analysis, the machine's token price chart. It really does look like a record of that intense speculation we were just talking about. Classic early stage crypto volatility. Anyone looking at this needs to understand what they're seeing.
Yeah, before we even walk through the ups and downs, we need to set the context with the market metrics, because these numbers explain why the chart is so wild. It's crucial to understand this isn't a mature, stable market. First, the market cap is tiny. The research pegged at around $2.78 million, microcap territory. But even more critical is the trading volume. Over a 24-hour period around early November, the volume was just $252,320.
Wow, only $250,000 traded in a day for the entire token.
Exactly. That's incredibly low liquidity. Think of it like a very narrow, shallow stream. It doesn't take much, a few large rocks, or in this case, buy or sell orders, to completely change the flow or the price.
So even relatively small trades can cause huge percentage swings because there just aren't many buyers or sellers lined up at each price level.
Precisely. That thin order book is the engine driving this extreme volatility. Modest buying can send the price soaring. Modest selling can cause it to crash.
Okay, with that low liquidity context, let's look at the timeline. The sources say the token saw extreme volatility in its first trading week, early November 2025. How did it unfold?
So it started with what you could call an initial stabilization phase. That was around November 2nd and 3rd. The price sort of bounced around between 0.000001800 and 0.0000002,000. Just the market trying to find its footing, figure out an initial value based on the hype and the roadmap.
But that didn't last long. November 4th saw a sharp drop, didn't it? The all-time low.
Yeah, the price hit what the charts call the capitulation low. It touched 0.00000001759. Capitulation here means the earliest, weakest hands likely gave up. People who bought right at the start got nervous about the slight dip and just sold out to cut their minimal losses.
Selling pressure exhausted.
Pretty much. And when the sellers disappear in a thin market,
Yeah.
well, that sets the stage for a rebound.
And rebound it did. November 5th was the big one, right?
A
The
tunk,
peaks.
yeah. A really aggressive rally. The price shot up to the all-time high of 0.000000391.
Let's just pause on that number. From the low, around 0.0000000000391, that's more than double, right? Like a 122% increase in a single day.
Correct. A massive 122% surge. That's not organic growth. That screams coordinated buying or perhaps a reaction to some announcement hitting that very thin supply. Classic FOMO, fear of missing out, likely kicked in as the price started rocketing.
But what goes up that fast in a thin market?
Usually comes down pretty quickly too, at least partially. And that's what happened next. November 6th saw the profit-taking correction. The price pulled back significantly, settling around 0.000000278. That was down nearly 29% from the peak just the day before. It's textbook mean reversion. People who rode the pump up took their huge profits off the table.
Still up significantly from where it started, but a sharp correction nonetheless. Even at that 0.000000278 level, the sources noted it was still up almost 19% over the preceding 24 hours, showing the volatility was ongoing.
Exactly. The key takeaway from this whole price action sequence.
What is it?
It's a perfect illustration of a pump and correction cycle, made extreme by the incredibly low liquidity. This chart isn't reflecting stable adoption or proven value. It's reflecting concentrated speculation in a market where relatively small amounts of money can dictate the price direction very easily. That susceptibility to flash rallies and sharp drops is the defining characteristic right now.
Okay, we've covered a lot of ground. The tech concept, the anonymity, the roadmap, the community, the wild price action. Let's try to synthesize all this for the listener. It really feels like a project of stark contrasts. We need to clearly lay out the risks identified by the research. So to summarize the major red flags you absolutely need to keep in mind.
Minimal team transparency. Seriously, minimal. No public founders for financial tool. Huge risk.
It's pre-launch. There's no working product available to the public yet, just promises based on that roadmap.
Extremely low liquidity. That 250K daily volume means high volatility and manipulation risk.
Tiny market cap. Around $2.8 million puts it firmly in the speculative microcap zone. High risk, high potential reward, but emphasis on high risk.
Limited marketing reach. Just over 1,000 Twitter followers. Indicates very little broad awareness or organic community building yet.
But it's not all red flags. There are compelling reasons why this project got noticed in the first place. The positive indicators from the research are also significant.
That active development timeline. Clear dates alpha in DEC, beta in Jan, launch in Feb 2026. Shows structure and intent.
A genuine use case. Privacy for crypto spending is a real need in DeFi. If they pull it off, it's valuable.
Built on Base. Using Coinbase's L2 is a solid technical choice for speed, cost, and credibility.
The virtual Visa card mechanism. It's a practical-sounding approach to the privacy problem for everyday spending.
That subscription business model. Having revenue potential beyond just the token price, especially with the Pro-tier API, suggests a path to sustainability.
So, pulling it all together, the picture that emerges is, well, it's Machines Cash as a very high-risk, very early stage, highly speculative bet right now. The potential utility is definitely there. It's attractive. But the anonymity, the fact it's not live yet, and that super volatile, low liquidity market action really crank up the risk factor. The price isn't reflecting stability. It's reflecting speculation on future potential.
Which leads directly to the practical takeaway for you, the listener. You asked us to assess this situation. Based on everything we've seen in the sources, the strongest recommendation is caution and patience.
Meaning,
don't jump in based on the current hype or price swings. The research strongly advises waiting for concrete validation. The first big test is that alpha launch, supposedly in December 2025.
see if they can actually deliver something functional.
Exactly. And even after alpha, you'd want to look for more proof points before considering it less speculative. Has it passed a security audit? Is there verifiable transaction volume happening on Base related to the project? Is there any more clarity on how they're handling the compliance needed for Visa integration?
Right. Without those validation steps, any investment or even significant usage remains extremely speculative. Wait for proof.
That's the core advice coming out of this deep dive. The risk reward is heavily skewed towards risk until those milestones are met and verified. #tag outro.
And that wraps up our deep dive into Machines Cash. What we found is a really interesting mix. An innovative idea targeting a real privacy need, built on a credible platform like Base, with a clear, ambitious roadmap. But that's weighed against this deliberate team anonymity, creating a major trust gap and a market showing extreme volatility due to thin liquidity and early speculation.
It really leaves you with a challenging thought, doesn't it? If a project's entire reason for being is financial privacy, the ability to operate in the shadows, how much transparency should we, as users or investors, actually demand from the team building those shadows? Does the promise of privacy for us justify the anonymity for them, especially before the product is even proven? It forces us to confront that question. Even in this world of supposedly trustless crypto systems, how much do we still rely on trusting the actual people involved?
Definitely something to think about, especially as we watch to see if that December alpha milestone gets hit. Thanks for joining us for this deep dive into the source material. We'll see you next time.